Involuntary liens may be broken down further into two categories: statutory liens and equitable liens. Statutory liens are automatically created as a matter of law or statute without any action by the owner. Property taxes are an example of a statutory lien. Property taxes are established by state and local statute and are automatically attached to the property. The property owner does not need to do anything to bring about the attachment. The property owner is not able to prevent the attachment of a lien since it is a matter of law. Equitable liens are placed by the court in the interest of fairness. Many judgment liens are considered equitable liens. A judge decides it is equitable or fair for an individual's assets to be sold to satisfy an obligation. In the interest of fairness, a judgment is awarded and may act as a lien against the individual's assets. Real estate taxes. Real estate taxes affect the real estate industry enough to warrant a separate discussion. Remember, real estate taxes are considered a specific involuntary statutory lien. State and local governments often use real estate taxes to fund substantial parts of their governmental operations. Real estate taxes are often preferred by municipalities for funding, since they are pretty easy to collect. Real estate ownership is easy to determine. Property owners have an incentive to ensure taxes are kept current because of the lien right held by the taxing authorities. Later, when lien priority is discussed, remember that property tax liens will usually take priority over all other types of liens. This means that property tax liens will be paid before most other liens, when a property is sold either traditionally or at a foreclosure sale. Do not confuse property tax liens with other tax liens. For example, a lien levied by the Internal Revenue Service for the payment of income taxes would not be afforded any special lien priority treatment. Real estate taxes may be broken down into two categories: general real estate taxes or ad valorem taxes, special assessments or improvement taxes. Both types automatically become a lien on the specific property to which they are attached. General real estate taxes are often referred to as ad valorem taxes. In Latin, ad valorem translates to mean according to value. In other words, the amount of a general real estate tax depends on the value of the property. We mentioned that states and counties levy real estate taxes. While counties are often the collectors of the tax, many other government entities levy or impose real estate taxes, such as cities, school districts, recreation districts, and utility districts. Since general real estate taxes are based upon the value of the property being taxed, the taxing authority must establish a value for each property in its jurisdiction. The process of valuing the real property subject to tax is referred to as assessment. Taxing authorities employ assessors who establish what the properties are taxed. For example, a county may employ a county assessor. The county assessor establishes the value or assessments for each property subject to tax within the county. Since the amount of tax due directly correlates with the value of the property, a property owner may disagree with the assessor's value of their property. If a property owner disagrees with the assessment of their property, each jurisdiction has a process of appeal. Assessors are essentially appraisers, employed by the taxing authority. They attempt to use the most recent comparable sales data to determine values for the properties. Some states make sales prices a matter of public record, making the assessor's job a bit easier. Some taxing authorities reassess the value of properties periodically in an attempt to keep valuations in line with market values. Other taxing authorities will only reassess the valuation of a property if the property is sold. In jurisdictions where periodic reviews are required, raising property values may prove problematic for homeowners. Let's use a hypothetical example. Assume an older homeowner owns their home free and clear. The homeowner is retired and on a fixed income. Because the homeowner does not owe a mortgage, their only housing expenses are the maintenance, insurance, and taxes on their home. If property values increase, the tax assessment will increase. As the tax assessment increases, so do the property taxes. The homeowner may not be able to afford the increase in property taxes. Many taxing authorities have exemptions or reductions on property taxes for certain individuals or organizations. Senior citizens often qualify for these exemptions. Other organizations, such as governmental organizations, schools, and religious organizations, may also qualify for property tax exemptions on real property they own.